Broadcom reported their Q1 2024 earnings with the full weight of the VMware acquisition borne on the financial statements. The market seems to have approved, though the fundamentals paint a different picture. Q1 revenue was $12 billion, up 34% year over year and 29% quarter over quarter. A good result by any measure, but of course most of that growth came from VMware. To be fair though, without VMware, revenue was up 11% year over year. The rest of the line items, however, were not so rosy. Gross margins were 61.7%, down from 68%, the average of the last 7 quarters. If you remove the amortization charge, however, gross margin was actually 73%. Perhaps the market is more informed than we thought. Operating profit was just $2 billion. Operating expenses more than doubled quarter over quarter on restructuring charges and selling, general and administration. Job cuts are on the horizon at Broadcom. Pre-tax income saw a jump of interest expenses. Broadcom took on about $30 billion of debt. Net income was just $1.3 billion, down 60%. Digesting a VMware will take some time before financial statements reflect the acquisition synergies. A look at our 9-quarter revenue graphs, we can see just how much impact the acquisition has on Broadcom's income statement. Revenue has been growing at 5%, gross profit by 4.3%. Operating and net income growth should return to the positive in the coming quarters. Let's look at the relevant ratios. Shares outstanding increased by 38 million due to the acquisition. This will negatively impact per share ratios. Earnings per share were $2.84 for the quarter. Sales per share were up to $25.60. Cash per share was softer to $25.40. Book value jumped to $150 with shareholder equity almost tripling to $70 billion. We annualized the EPS to get a PE of 123. The S&P 500 PE is 28. Based on that ratio alone, we wouldn't be buying Broadcom at these levels. PE growth is negative 1.83. The debt ratio actually improved to 0.41 despite all the new debt. Goodwill and intangible assets added nearly $100 billion. Debt to equity is 1.05, meaning there is $1.05 of debt for every $1 of equity. Interest coverage was just 2.25 times, but that should improve as charges are eliminated and debt paid down. Short-term liquidity ratios look good with the current ratio at 1.33, the quick ratio at 0.83, and cash at 0.58. Current liabilities increased more than current assets. Return on assets at 3%, return on equity of 7.5%, return on capital employed at just 1.3%, and return on invested capital showing 1% are not very impressive. Would you touch this stock? The cash flow numbers look reasonable. Operating cash flow was $4.8 billion, better by 19% year over year. Investing activities reflect the acquisition of VMware to negative $25.5 billion. Financing inflows were $18.3 billion as Broadcom borrowed $30 billion. Free cash flow to the firm stands at a healthy $12 billion. Broadcom paid $5.21 in dividend in the quarter, yielding 1.48 on an annualized basis. That's a growth rate of 16% and a payout ratio of 184%. That means they paid out more in dividends than their net income. That's a strong signal of future earnings growth. Enterprise value of Broadcom is $645 billion, 13.5 multiple to revenue, a 21.87 to EBITDA, and a 13.6 multiple to free cash flow. Broadcom provided full year 2024 guidance saying that revenue would be $50 billion with an EBITDA of $30 billion. We didn't want to speculate on operating profits and net income given that there is a lot of work to do in improving margins and integrating VMware. Key takeaways from the report are that Broadcom has good cash flow. We like the dividend continuing to grow. Broadcom has good short-term liquidity to keep the business moving forward. On the con side, the PE is excessive at 128. VMware integration will take time to realize its full synergy with Broadcom. Goodwill and intangibles booked in at $100 billion as assets. Is that really reasonable? The new debt will have to be serviced out of future earnings. That being said, we give Broadcom a neutral rating. We have no exposure to this company. Like and subscribe.